Who it ain't for the weak. Growth is the game. We play it real tall from the bottom to the summit. We rise, never fall. Interview the legends, success stories told. Risepreneurs, hearts made of gold. Strategies unfold. In the struggle, grace. Hardship and challenges, yeah, we still embrace.
Welcome back, everyone, to another episode of the Risepreneur podcast, the show dedicated to all the entrepreneurs and business owners who's looking to grow, scale their businesses, and ultimately exit at the highest valuation possible. So today we have a special guest with us. I think we'll learn a lot. His name is Noah Rosenfarb. He is a third-generation CPA and also a founder of the Freedom Family Office. If anyone follows the show, we've seen already a couple of shows with Peter Culver. He's a co-founder, a partner. We will be looking at things from slightly different angle today, looking at the same thing as an exit of the business, but from different angles. He's also author of multiple books, one of them which I'm looking to get, but Peter said that you're working on the newer version, The Exit.
Yeah.
Should I wait or get what you have already there? How long until you publish it?
Coming soon. Exit Rich Beyond Money. Coming soon.
Awesome. All right, Noah, say hi, and we'll begin.
Yeah, nice to be with you. Thanks for having me, and I look forward to seeing what we could share with the audience.
Awesome. All right, so can we, as always with everybody else, just like with everybody else, can we go back in time? You mentioned, I've seen one of the podcasts, you mentioned that your father was a CPA, and actually you're the third generation now.
Yeah.
So being CPA, working, how did you end up with the idea that the family office, that's not something that comes to everyone's mind when they're CPA, like not into like tax strategies or working for a firm or start my own firm. It's family office.
Yeah, so I'll share with you a bit of the background. I joined my dad's accounting firm when I graduated with a degree in accounting and became a CPA while I was with him, helped him scale his business from 12 people when I joined to 70 when I left. And he sold that to Markham, a top 20 CPA firm. I knew I would say maybe 3 years before the sale that I was not going to be the buyer and I was going to do something else. At the time, I testified in divorce court about how much money people made and how much their businesses were worth. And I saw an opportunity. A lot of the clients that we were representing were the non-titled spouse. You have kind of in the parlance of the divorce law, the titled spouse, the spouse that's going out and working, and maybe the non-titled spouse who's home raising their children. In almost all the cases I was dealing with, it was the wife that was the stay-at-home mom. And what I noticed was they were getting a large settlement out of their divorce, and they had no idea what to do. And I recognized that I was uniquely suited to advise them. And so I built what became, I believe, the first family office for divorced women. And I created that in 2007. I grew that for a few years. And ultimately in 2014, I exited that business and was retired for a couple of years. And in my retirement, a lot of friends were asking me if I could help them with their investments, with their estate planning, with their insurance, with real estate investing. And I really enjoyed the process of helping them and sharing what I've learned with them, but I didn't have an infrastructure. And right before COVID, I decided to get back in the game, build an infrastructure to help these entrepreneurs that I cared about so much, and built out with Peter this philosophy about how to become rich beyond money, and built a team of accountants, lawyers, and financial planners that can help them identify what their true goals are and the best path to get there.
Awesome. What a journey. Can I ask why not take over your father's business? Was the court case that impacted, or you decided prior to that?
There were a handful of reasons. I would say as a buyer of a business, I didn't think an accounting firm was the best business to acquire. So at the time, the firm was probably worth around $10 million. And I just didn't see the advantage of paying $10 million for a service-based business where I knew the personalities involved. We were 13 partners. Everyone had a piece of the pie. My father had the majority control. And I just didn't see that the business really had true value. And in hindsight, I guess I was right, because when my dad sold to Markham, within 3 years, pretty much everybody was gone.
Wow. Interesting. Would that something that usually would happen with the accounting firm because of so many partners, or that?
It's all firm dependent. I think a lot of times people acquire sole practitioners and they take over their book of business, and those tend to be highly successful in terms of client retention. The traditional accounting business is very retention oriented. Our business was unique because it was forensic accounting. Of the 15 million in revenue that we did when we sold, 13.5 million was forensic accounting. Forensic accounting is a different business than traditional accounting. It's not recurring work. You have a relationship with a lawyer who's introducing you to their clients, and that relationship is very personal with the lawyer. So if the accountant who has the relationship leaves, the work leaves with it.
I see. Okay, I see your perspective. All right. So then, when you started working and before you exited, what that looked like when you exited the helping women after divorce?
So I scaled this business, but I couldn't really scale past myself. The divorce lawyers that were comfortable introducing me to their clients to manage their money and file their tax returns and help them pay their bills and deal with financial questions, they appreciated and valued the insights and the services that I was able to offer. But I tried building a team and I was unsuccessful at building a team. So it was really a lifestyle business more than anything. And what I ended up selling was the intellectual property of that business to another registered investment advisory firm that wanted to essentially replicate the model that I had created in the New Jersey market. It was an exit that was sufficient enough for me to not have to work anymore, but it wasn't a large 8-figure exit.
And it was enough for you to feel that you could retire. That was
Yeah,
late
not so
30s?
much from the exit itself. It was the 20 years of real estate investing that I had done prior and the 20 years of savings that I had done prior. So it was just being a turtle and always spending less than I made, always putting money aside and investing it for growth, and not necessarily being focused on how much money am I making, so how much can I spend? It was really about how do we keep our lifestyle conservative. And that way, when I got to be 40 years old, I could say, all right, I don't need to work anymore because I could live the lifestyle I had on the investments that I had already made.
Awesome. And I'm going to dive right into that. That's what I'm really curious about. And before you exited, that was after you published that book and talked about the exit.
Yeah. And so what happened there is an interesting twist or turn of events. So despite the fact that our business was focused on forensic accounting and my personal practice was focused on divorce, I had a handful of entrepreneurial clients, the clients of ours that often we were preparing their tax returns and financial statements. I got into providing business consulting services for them and helping them scale their companies. It was a small part of our business. It wasn't the bread and butter of our accounting firm, but it was something that I personally enjoyed. And through that consulting work, I helped a number of companies scale and exit their business. And one in particular had what I thought was the optimum outcome. They had told me how much money they wanted. I helped them get that much money in the sale of their business. And lo and behold, 6 months later, I'm sitting in a therapist's office with them and they're talking about maybe getting divorced and they're so depressed. And it hit me like a punch in the gut that I was the number one advisor to this entrepreneur. And I was unaware that what they were telling me what they wanted, which is what I got them, was not really what they wanted. It was this facade of people thinking that the money is going to bring you happiness. And I was bought into that myself. And so through that process, I wanted to figure out, what did I miss? And so I went and did a deep dive. I interviewed over 100 people that had either sold the business or advised owners that sold their business. I had a podcast back in 2012 where I was interviewing people about this. And I just learned that at the end of a transaction, if an owner doesn't look at their calendar and see things that excite them, and if they don't identify where their meaning and purpose is going to come from in their life, they're probably, after some honeymoon period, going to be very upset that they no longer have the business that they had grown and worked hard on.
Yeah. Based on what I learned, mostly men not guilty, a victim of that, right? Because men usually at work doing their thing. And when it's time to retire, the lifestyle changes. With women, more or less, lifestyle did not really change. They were looking at the older generation. They were all around the household, the kids, and so they continued to do what they were doing. Nothing really changed. And with men, after they retire, all of a sudden there's depression and actually exiting this world very fast after not being productive anymore.
And there's an interesting corollary between the divorce work that I did and the exiting entrepreneur, which is very similar, and most people don't get it until I explain it. But you think about a woman who's a homemaker, who's raising her children, supporting her husband in his career. After the divorce, they lose that identity also that they once had. And so it's a very similar transition to be coaching and advising a newly divorced woman as it is an entrepreneur who recently sold their business.
Yeah, but wouldn't you say that for women it's also not something totally new, because they usually find their kids, grandkids, go out and involve in their lives. Men being at work all the time, they're not really patient enough, I guess, to be around kids and give as much time and attention as women would.
In general, yes, but I would still say that we see it a lot with our clients when they're becoming empty nesters. So that transition of being an empty nester, if the husband maintains his position as the owner of a company, but the wife was a stay-at-home mom and now there's no kids in the home, it's essentially the same set of circumstances for her, where now, where is her meaning and purpose coming from? What's getting her up in the morning? What responsibilities does she have? How is she fulfilling her end of the bargain in their partnership? And I think it ebbs and flows depending on which stage of life you're at and what your circumstances are.
Interesting. I'm just picturing my parents, right? So they both exited. My mom continues to work, and my father's health issues did not allow him to be as productive as he used to. And interesting. All right, so can we share with our audience? I mean, everybody knows, they say it's common sense, everybody knows, but at the end of the day, our action shows otherwise, right? Everybody just in that working in a business mode. You're pretty sure familiar with the hierarchy of needs, Abraham Maslow's, right?
Yeah, of course.
Most people fall into the bottom three, right? So we busy with, okay, I got to sustain myself. I got to provide security, shelter. I got to have continuation, right? And later on, all of a sudden, they explore and go after knowledge. And next thing they know, it's self-actualization, right? The purpose. I like that your whole website, the whole ideology behind the Freedom Family Office, the philosophies, the values, the principles, the fundamentals around making you think about the end in mind, right? Fulfillment. At the end of the day, of the fulfillment, the freedom in money, time, and the purpose, like all that comes together. So from your angle, how one should speed up that journey where they will realize that, because I speak to entrepreneurs and they think that working 60, 70, 80 hours a week, that's what entrepreneurs do. Yes, be all the time at work, but don't work because you have to. In their case, in most of the cases I see, they have to, because if they're not, they believe that the company would fall apart. So how one starts to bring that awareness and start to transition towards the journey that there's a lot more to life than just in day-to-day work?
I've always found that until your income exceeds your expenses, it's hard to focus on anything else. And for a lot of entrepreneurs, one of the reasons they're working 60 or 80 hours a week is because their lifestyle is consuming all of the income that they're generating. And the way to combat that is either to increase your income or to decrease your expenses. And most people aren't willing to look at what would it take to decrease their expenses. They just want to look at what would it take to increase my income. And I think that's an unfortunate perspective that most entrepreneurs have, because it puts them in this wheel, the hamster wheel, where all they have to do is run faster and faster to try and generate more income, because they want to go on a ski vacation, or they want to go on a summer trip, or they want to be able to go out to dinner 3 nights a week. But if they were to sit down with their spouse and potentially their kids and think through 2 alternative universes. One is dad's going to spend the next 10 years missing dinner. He's going to spend the next 10 years missing your soccer games, He's going to spend the next 10 years missing out on many of the things at home, including just washing the dishes and taking out the garbage and participating in the home life. But at the end of that period, the family's going to have more money. And as a result, maybe the kids are going to go to private colleges versus public college, or the kids are graduate without college debt, or the parents are going to be able to have a second home, or they're going to be able to fly business class instead of coach. That might be the outcome. But the second scenario, the one that most people aren't looking at, is what if we really tighten our purse strings? And what if it's brown bag lunch every day? And what if it's, everything's hand-me-down clothing, and we're staying in our small home, and we're going to have the kids share a room, but dad's home for dinner every night, and dad's able to make it to the games. And I think it's just a question of what is a better life. And for a lot of people, they don't reflect on which life is better. They just automatically assume struggling and working hard for more income is the right answer.
Isn't that interesting? How you do one thing is how you do everything. I mean, in business, you can observe pretty much the same thing. You ask a business owner, what are you in business? They want to show off like how many employees they got. But employee is a representation of expenses, right? The focus is on let's go out there, market ourselves, bring more revenue instead of focusing on profits and cash flow, right? So if you minimize the expenses and not necessarily have to go out and go crazy on the expansion, at the end of the day, you can accumulate probably even more profits and cash flow than while you were running around and diminishing all your margins and so on. Yeah. So can we go into because only recently I read Rich Dad Poor Dad back in 2000, just to give you the intro. I did not pay attention that the ultimate goal is investor. So I was an employee. I was like, okay, I'm going to be a consultant, but I was self-employed. I need to go into a business mode. To a lot of business owners, they think they own a business, but in reality, they're self-employed because they cannot remove themselves. So let's say you even become a business owner, you're not really going into the investment mode, right? So somehow when I read that, I missed that part. So I was growing through my journey step at a time without keeping the end in mind. I thought that the business owner is what the end is, right? So I need to build a business, ultimately to have that successful exit. Yes, some failed, some succeeded, but it's never satisfying, right? So when you start with the end in mind, what I found is that, and again, common sense, but not common practice, the cash flow that we produce is active cash flow, need to be partially, little by little, transitioned into passive cash flow. So in case active cash flow is out, or when they even out, or even they can completely replace it, you never stop the cash flow. And even what you just shared, over the time, you were able to save and invest it in real estate and so on. So you had enough passive income that you thought that it would be okay to retire.
Only did I think it would be okay to retire, but I didn't want more. I felt like more would be an obligation. I don't want to make my kids wealthy because I'm wealthy. And so I felt like there'd be some obligation if there's more that my kids would have expectations or some sense of entitlement. I felt like they would just create another problem of how am I going to what am I going to use it for? It's either going to be for consumption personally or to give it away. And even giving it away is not an easy thing to figure out.
Yeah. So that part, to produce that passive cash flow, to most people, you got to produce enough to invest into real estate. It looks like everybody's most secure, I would say, and everybody's mind to a method to produce passive cash flow is real estate. But real estate also goes up and down. It has its benefits, and it's not necessarily the only vehicle. What would you suggest for entrepreneurs that have active cash flow, that have some cash flow on the side, or able to diminish some of their expenses and produce that extra cushion, start building up that passive cash flow to ultimately replace their active cash flow?
With a plan, right? I think, I'm a professional planner, so I think everybody, and therefore the plan to get there is different. I would say in terms of asset classes, I think you should test one asset class at a time. So invest in syndicated real estate deals, see if you like them, or buy a 2-family house and be your own landlord, see if you like it, or start making loans, hard money loans or private debt that you want to invest in, see if you like it. Go around the horn of different investments while you're making an income. Because the challenge for a lot of entrepreneurs that sell their business is now, for the first time in their life, they have to invest for passive income. Maybe they've invested historically for growth, maybe they've invested historically just in their business, but now they have to be a beginner at generating income from their assets. And that's a difficult transition because you have to learn all these new asset classes and figure out what you like. And so a lot of people like to start with real estate. It's a comfortable place to start. Other people like to start with the stock market, publicly traded investments and publicly traded bonds. Nothing's wrong with that. There's liquidity. It's a great way, especially while you're in your earning years and maybe you're funding a 401k or you're funding an account that has liquidity. So in the event you need some money, you have access to it. In retirement, you may find that you want to transition from wealth accumulation, which is, I don't really care about income, I care about growing my net worth, to wealth utilization, which is, okay, now that I've built a nest egg, how do I start using it to support my lifestyle? Your investments might shift. So you may go from being focused on growth-oriented investments to income-oriented investments. You may be focused on high-risk investing to lower-risk investing. And so you'll have a shift over time, but the benefit of doing the legwork early on in your career is to test these ideas of which asset class do you like.
Going back to Rich Dad Poor Dad, the end in mind, the investments, right? So just like business owner is exploring every aspect of the business, marketing, sales, operations, finances, legal, and so on, diving in deep. So while doing that, we should be aware that this is not the end in mind. We should put, if not as much effort, exploring the investment world. What type of assets out there, how to diversify and change the focus when need to, before you would actually exit the business and be a full-time investor.
Yeah, one of the rules of thumb that we like to share is to generate 20% of the monthly income that you want before you sell your business. Because if you're able to generate 20%, a lot of the clients we work with, they're spending $25,000 a month, $50,000 a month net of taxes. So this means they're generating $5 or $10 grand a month of passive income from their existing investments before they sell their business. In order to generate 60 to 100 grand a year of passive income, you probably have invested in things that are working, like $500,000 or $1 million. But what happens is, in order to get $500,000 to $1 million worth of things that are working, you might have invested, $1 million or $2 million, because not everything works. So you'll have that experience and you'll know, what is it that I like doing versus what is it that I don't like doing.
Can you repeat that again? 20% of active
Of your
income, desired lifestyle expense.
Yeah, again, if you're making $500,000 a year as an entrepreneur and you want to maintain your lifestyle, after taxes, you might be spending 30 grand a month. So try and get 6 grand a month coming in from your investments before you go and sell your business and end up with $2 million. And what are you going to do with $2 million? How are you going to replace that income?
Yeah, got it. All right. Thank you for sharing that. Peter was sharing about your expertise in the CPA world and taxes. What would be some of the strategies that a lot of us could jump into that maybe not everyone knows on the tax strategies? The business transitioning into investments, selling a business, like what should one be aware of and what one should have in place?
So I'd say that much like your financial plan, your tax strategy is going to be driven by your persona and your goals and objectives. And I always say there's two things to consider before you develop your tax strategy. And the first is, what's your tolerance for complexity? Because I could show you how to pay very little in taxes, but it may involve a lot of entities, it may involve a lot of lawyers, it may involve a lot of money movement, it may involve using other professionals. And so you may say, like, that's just too complicated. Okay, so you have to know, how much complexity are you willing to tolerate? The more complex you're willing to get, the less tax you'll pay. The second thing you have to evaluate is, what's your willingness to defend yourself in an audit? a lot of people, they have this mindset that I don't want to raise any red flags. That's the words they like to use. I don't want to raise any red flags. Okay, why not? I don't want to be audited. Okay, why not? I don't want the IRS to change what I did. I don't want them to tell me I owe them money. Okay, your willingness to take a tax position is going to be very limited, because what you're really saying is, I don't ever want to disagree with the IRS. And the IRS has a clear set of rules. And so if you never want to disagree with them, you've always got to err on the side of caution and just do what you think they'd want. On the flip side, someone like me, I tend to think about what's the risk versus the reward. So right now, the IRS is auditing about maybe 10% of taxpayers that make over $10 million a year, and less than 2% of taxpayers that make under $400,000 a year. So even if you're making 10 million a year, you still have a 90% chance that the IRS is not going to ask you to defend your position on your tax return. Okay, so let's assume the IRS does challenge you on a position that you've taken. There's really three things they're going to do if they disagree. One is they're going to say, pay me the taxes that you would have paid me had you done it the way I wanted in the beginning. If I did it the way you wanted in the beginning, I would have given you the money in the beginning. And now I'm giving you the money, so it doesn't really cost me anything. The second thing they're going to say is, well, you should have given me that money 3 years ago. You're giving it to me now, so I want interest. But the good news is the IRS is a relatively friendly lender. They typically lend it a little bit more than what you'd earn in a bank account. If you've done something smart with the money, that's a wash too. And in some cases, maybe you're capturing a spread. The IRS is charging 6% and you made 12%. Okay, so maybe that's not so bad. The third thing they could do, which is really the punitive thing, is charge you a penalty. And the penalties can be quite substantial. But what most taxpayers don't know is there is penalty insurance. You can get, in the form of a tax opinion letter, basically penalty-proof insurance. So you pay the lawyer to write you an opinion letter that says, hey, I looked at this thing that you're doing, and I believe you're more likely than not to get upheld in an audit. If you have that letter and you show it to the IRS, they can't charge you a penalty. So what's the worst case scenario if you get a letter like that? Is you're just going to pay the tax that they would have had you pay in the beginning and the interest, which hopefully you made. The other way to get rid of the penalty is oftentimes, especially for things that are smaller, the IRS might give you penalty forgiveness. And if you haven't asked them to forgive a penalty in the last 3 years, often they will agree to waive the penalty.
Interesting. And everybody fears that audit, and therefore they push away all the possibilities that could have been leveraged.
That's, I think, the soul searching that each individual has to do and say, what's my most important objective here? Is my most important objective to take positions that I think would benefit myself and my family? Or would I rather just make sure I do whatever I can so that if the IRS takes a look, they'd say, oh, this is perfect. It's just the way we would have done it. And that's up to the individual. I don't have an opinion that I would advocate for someone to do it one way or another. I just know what I do. And most of the clients that we work with, they look at it and they say, you know what? I'm taking risks in my business all day long. Why not take a risk on my tax return that the IRS might disagree with me?
Got it. Awesome. Cool stuff. Can we shift to exiting the business?
Of course.
That's a third thing that I see as a benefit from you, and benefit is from you. And you wrote a book about it. Your whole business set around that, right? People exiting. So there's a lot of strategies. Some of those we touched on with Peter. Anything that from you, and maybe like top 3 things that one should be looking at to sell at the highest valuation, but also make sure that the transition and the life after selling would also benefit, right? I heard some people exit without exiting. Some people stay on board. Some people still have some ownership and they sell multiple times before completely exiting. So from your angle, like anything that comes to mind that would be cool, that if, I know every situation is different, but if there's 3...
I think it's the soul searching that the entrepreneur needs to invest in prior to engaging an investment banker. Because what most entrepreneurs, and the most often reason an entrepreneur is going to sell is because they're frustrated and tired. That's the most often reason. But 75% of businesses that are listed for sale never sell. And that's because the owners haven't created enough value to entice someone else to give them money to sit in their position. So if we put aside, I think you've got to talk about deal sizes. If an owner's making less than $500,000 a year, in almost all cases, the buyer is buying their job. And it may be a much better job than the job they have now. And so it's an attractive opportunity. It's also a job with a lot of upside because they own the business. But if we put that aside, that's not really our target market. More of the clients that come to us, they're making a 7-figure income. Maybe they have an 8-figure net worth business. Their business is going to sell for 10 million or more. So they have a substantial company, a company where they could be out of the office for a week. And yes, maybe they're needed for a phone call or a meeting or an email, but they can actually take a break from their business. When you're in a business like that, one of the things you want to optimize for is putting yourself in the investor position. Can I be an investor in this business and not have to be the operator of this business? And the more work you can do in advance as an owner to shift your own time and effort from being an operator to being an investor, you'll actually get a higher multiple for that company. Because the buyer that's coming in is going to see, oh, I'll use myself as an example. Noah takes the summer off. Noah takes Wednesday and Friday off. Noah only works on school days. That must be a business that doesn't require his consistent time and effort every single day in and day out. And when there's an emergency, there must be someone else that can handle it. I'd rather buy that business than buy somebody else's business, which has the same financials, but that person hasn't taken a vacation because they can't leave because there's always an emergency every day.
So again, goes back to that place where think of yourself from the beginning as an investor. Look at the end. Keep the end in mind while you do what you do. So making it more attractive to investor, you also increasing the pool of potential buyers. So that creates multiple people looking at it. Probably try to beat and get you the high valuation as well.
I'd also add that if you're an investor in your own business, and a lot of the businesses that our clients sell, they're getting to 10 times earnings, anywhere in that mix. When you start to get 10 times earnings, maybe there's an advantage to selling to a third party so you can have diversification. But if you're going to get 4, 5, 6 times earnings, the reality is that when you get that capital, you're going to need to generate somewhere around a 20% return on those investments to replace the same cash flow. And it's really difficult to generate 20% returns consistently over time. It's not something that I would encourage one of our clients to envision they could do repetitively for the rest of their life. And so the question then becomes, wait a minute, would I rather be an investor in this small business that I know so much about, where I know all the people and I know what my responsibilities are? Or would I rather diversify and take that capital out and push it around to a bunch of other investments where I'm not going to get the same return, but perhaps I have less risk? And for a lot of entrepreneurs, once they get to that spot where they're an investor in their business, maybe I'll hang out here for a few years, because if I could print another $3-4 million a year for the next 3 or 4 or 5 years, and I could still live the lifestyle that I want, then when I go to sell it, I'm going to get the same terminal value, but I will have accumulated more savings, and I could give myself more experience being that investor and living that retirement lifestyle.
So it's not always try to exit. I like the point that you brought up, that in business, yes, even when I now try to raise funds, it's like a standard. People want 20% as a return on investment. Same with Warren Buffett, right? He consistently kept it at 21 or 22% for all these years. But not everybody can go out there and invest, even in real estate, right? It's 10% on average.
Yeah.
So yeah, keeping that in mind, that where else I can find and how else I can diversify. If I get my business to a place where it does not require me to be in it all the time and even on it, position above it as an investor, I can actually keep producing those earnings and invest into other assets. Interesting. Okay, good stuff. Any stories come to mind, like a case study that you would want to share, positive and maybe not so positive, when somebody exited and it was the biggest mistake because they did not think of those things, and another one maybe where you through your help they were able to position themselves into a better place.
Yeah, I would say often, probably once a month, somebody calls us to say, I sold my business this year, and what can I do? With how do I save on taxes? I heard you could save me on taxes. And the reality is, we can save you money on taxes after you've sold your business, but it's a lot easier to do it before. Because again, going back to the complexity and the audit risk, when you've sold a business, there's just not as much available options. So I would say that's probably the biggest mistake I make, is an entrepreneur waiting until after they've sold the business to address their tax situation. And again, there's some things we can do to triage the situation, but it's nowhere near what we could do beforehand. I'm trying to think. I had one come in last November. I remember he sold his business for 20 million, very sophisticated, intelligent guy. And he had sold the business in May. He didn't hear about us until I guess it was November, and he came to me right before Thanksgiving. And we saved about $1.5 million in his 2023 taxes. We'll probably be able to save about $1 million in his 2024 taxes, and we're amending his prior year returns through a strategy we use involving solar tax credits. But what he's become is like an evangelist for our business, because he's telling all of his friends, hey, these guys, I came to them after I sold and they saved me 7 figures in taxes. But I've seen what they've shown me, what they would have done for me had I met them before. We would have saved them about 7 million in taxes. So I would say get started early. It definitely works in your favor. You don't have to do anything, but tolerating complexity is much easier before you're involved in the sale of a business. Because once you get involved in the sale of a business, the average owner is going to spend 1,500 hours on that sale process, between interviewing the bankers and preparing the decks and working with due diligence and interviewing buyers and fireside chats and dealing with the owners and financing and structuring. That's a very busy, time-consuming process in and of itself. Another reason why, if you're an investor, it's a lot easier, because your business will continue to run while you're going through that process. For owners that are deeply engaged in their business, now they have a second job to get the business sold. Maybe a success story. We had a client, and they came to us early. They met me through the internet like this, and listened to what I had to say. They reached out. They were selling their business. It was going to be a big chunk of money for them, life-changing amount of money. And we ended up, what I think is most interesting about this case is, after we went through all the options, they decided they wanted to pay their taxes. And it was really interesting for me to witness that, because most of the people that come to us want to avoid paying the taxes. And at the end of the day, because this was such an amazing exit for this entrepreneur, what he said was, I never imagined having this much money. And so if I have to give, in his case, I think he paid $13 million to the IRS in the year that he sold the business. He'll pay more over time, but that first check was $13 million. And he just said, I have a lot of pride that I could pay this check. I can make my contribution to the country that provided me with this opportunity. And I don't have to worry at all that the IRS is going to disagree with me about anything. And I'm going to sleep well, knowing that not only was I able to pay a 7-figure bonus to multiple employees in my company, not only am I able to pay the government this 8-figure check that they'll be able to use to fight wars and do whatever else they want to do, but getting out of this transaction enough money for myself, for my kids, for my grandkids, and I'm happy about it.
Awesome. Interesting values. Wow. You such a variety of the angles one can take by looking at the same situation.
And I think it was important for us as advisors to the client not to try and impose on them what we believe or what we might do for ourselves, but really to help them understand what is it that they wanted to do, what was the best outcome for them and for their family. Yeah, I'd love to beat my chest and say, hey, I saved this guy 13 million in taxes, but that's not what he wanted.
So can we go back? I have a question. Let's say a person has a business, has everything running. He's already positioned as an investor. Everything functions without him. So now he's thinking to sell. How in advance they should be reaching out to someone like yourself to bring it to your attention?
I would say usually a year to 2 years before you want to close your transaction. So It usually takes, and most entrepreneurs don't really know it, but the average transaction is going to take 9 months to get closed from the time you hire the banker to the time you're closing on your business. That's about the average. It's usually never done faster than 6 months. And it's not, if you're going to sell the business, it's probably not going to take more than a year. Quite often, the first attempt at selling the business is a failure. And so you've got to go back to the drawing board, get your ducks in a row again, and try a second time. I like to say, just call us before you call a banker. Let us take a look at your situation. Let us understand what you're trying to accomplish. And then one of the services that we provide, in addition to helping you get clarity on what it is you're really trying to accomplish, besides just getting the most amount of money for your business, we're going to help you identify what is the life you want to live when the business is sold, and how do we reverse engineer that. And again, it might mean owning the business longer than you thought, but it's going to get you to a better outcome.
In that 1-2 years that prior to close, what are the activities they go through with you to position? You talk about what life after exit looks like, to determine, okay, you're probably going to have to stay or don't sell in full, or sell and stay on board. So is that what you're referring to?
We're working through those issues to identify for them. Do they want to sell 100% of the business? Do they want to sell control of the business? Do they want to sell a minority interest? Do they want to sell to a strategic buyer, to private equity, to family, to their key employees? So like thinking through all of the options so that they can get clear on what option they want to pursue. If they just try and throw it against the wall and see what sticks, it's usually not going to create the optimum outcome. What we really want to identify is, if you want to sell control to a private equity firm and stay on board for 3 more years to 5 more years because you really believe in the business, but you're at a stage in life where you'd like to take 20 million off the table and keep another 10 million in the company, great. But you might not know that. And you might not understand the dynamics of that and how does it work to roll equity. And maybe you talk about your family and your estate planning strategies and goals. And so we're going to weave all of that together so that before you hire a banker, you have a clear path forward for who's going to be your buyer, what's the minimum cash price you're willing to take, what are you going to do with those proceeds when the wire hits your account, what's your estate plan look like, and how do you engineer it before a transaction. And then again, the thing that really is the leading banner for us is helping people save money on taxes, because that's where they get the immediate ROI on the investment in our services.
What the typical exit looks like, that like without any sophistication? I'll give you an example, right? In my world that I'm learning about acquisitions and so on. So if it's seller financed, right? If you take a portion of it and spread it over 5 years, you're not necessarily collecting you're not fully collecting the whole amount to pay the tax. Is that like a typical setup, or is there any other ways that they set up?
Depends on the size of the business. The larger the business, the less seller financing is expected. Again, because the more you're an investor in your business already, the less risk there is that the business is going to stop without you. When you're buying a small business where the owner is fully integrated, has relationships with every customer, maybe delivers some of the product or service themselves, those businesses, you want the seller to finance it because you want to ensure that they're there to help you succeed in the long run. On a larger transaction, that might be still an important component, maybe 20 or 30% of the purchase price. In smaller businesses, it could often be 80% of the purchase price. So I would say that you want to know that going into your sale process also. Again, how much cash do you need at the closing table to feel comfortable signing?
So what the, again, typical setups look like, if again in the larger businesses?
Yeah, in the larger businesses, I would say, again, you have control, change of control, majority sale, and you have minority change sales, and you have 100% sales. All 3 of them are structured a little bit differently. I would say on the private equity buyer, the private equity buyers tend to purchase a controlling interest. They tend to want the controlling shareholder that's selling to remain committed to the business. They tend to give equity to the team that's already there that they can invest in, so that next sale to the next private equity firm, everybody can make another chunk of money, including the management team. And I think those are the most popular first generation transactions. So if you've built a substantial company that's generating probably 2 million or more of EBITDA, odds are you're going to sell to a private equity buyer if you want to sell control and not, but you still believe in the future. If you want to sell 100% of the business because you don't believe in the future, you want someone else to take all of that future away from you, more likely you're going to gravitate towards a strategic buyer, someone that's going to be able to come in, take all of your customers, all your resources, all your intellectual property, and sort through what they want to keep and what they want to get rid of.
Mm-hmm.
And I find for a lot of entrepreneurs that built their teams themselves, they're a little hesitant to give that level of autonomy to a buyer because maybe Susie's been with them for 20 years in accounting and the buyer's not going to need Susie anymore. And they have to decide emotionally what's better for them. Are they willing to let someone else terminate their long-term employees? Do they want to give them just a bonus and say thank you? Or would they rather sell to private equity, who's more likely to keep things intact?
Yeah. I hear this concept of roll-up. Now, in your experience and businesses that you've been involved in their transactions, how many of them were part of some kind of roll-up versus private equity that would continue grow it?
It's a good question. I don't know that I have a percentage. I would say, again, for the seller, they should identify if they'd rather sell to a strategic, which might be a private equity firm doing a roll-up. That would still be a strategic acquirer. And in some cases, they want to sell to private equity and be the platform. And so I was involved a long time ago in the sale of a platform acquisition where I had been advising that company for a decade, helped them sell to a private equity firm that just bought first generation businesses. They only bought from owners without brokers involved. And their goal was just to support the entrepreneur and provide them with capital to go out and execute on a roll up. We did that. Then we sold to a larger private equity firm. And then that was the plan and the business model. If you want to be a platform, then really you're probably not looking to take off the investor hat. You really are probably going to be in the operator position because you're going to continue to operate that business. You're just going to do it with someone else's balance sheet. So you could go and do an acquisition without really feeling the risk to yourself personally. You've already cashed out and taken enough chips off the table to give you some financial freedom. And now the equity that you still have in the business, of course you want it to grow in value, but if it crashes and burns, you're still going to be okay.
Awesome. And at the same time, it impacts the whole tax strategy.
All of these will be your tax strategy will be driven by who's the buyer, what percent are they controlling, and how long are you going to be working for the company.
Yeah. So the bottom line, as a summary, you got to see the end in mind. You got to see what the final play would be, and identify that point B. You need to reverse engineer and see what will actually get you there. But before making that major decision, gotta speak to someone like yourself, Freedom Family Office or some other, who would play that strategy, and while in a business, see if you can practice investments while having that active cash flow. Yeah, very good. Noah, anything you want to share prior to concluding? Any message you want to put out there?
Yeah, I think if you're an entrepreneur that's listening, that's considering exiting your company, I'd welcome the opportunity to have you go to exitwithfreedom.com and you could download a free ebook there. We'll also share with you a bunch of resources of things that you should be thinking about before you engage with a banker. And of course, we'd welcome the opportunity to speak with you.
Awesome. We'll include all those links below this video. Would you want also to include your LinkedIn page?
Sure. Yeah. Anybody feel free to reach out to me, Noah Rosenfarb. I'm on LinkedIn. I post a lot of content about wealth and taxes and real estate and lifestyle. So I'd appreciate if you enjoyed the interview today. Follow me on LinkedIn.
Perfect. No, thank you very much for joining us today.
Thank you for having me.